What's up guys, welcome back to another video. In this video I'm going to be talking about the only 3 different types of liquidity that you need to know when trading, and this is one of the more simple smart money trading concepts, but it's definitely one of the most important trading smart money concepts. So let's get straight into it. So first of all, there are 3 different types of main liquidity. And all liquidity is where money is laying in the market. Now there is a very long description if you put it on Google, but all liquidity is money laying in the market. So the 3 different types of liquidity are trendline liquidity, equal high or equal low liquidity, and buy and sell side liquidity. Now buying and selling side liquidity is a bit more complicated, so we'll focus on that last. And first of all, we'll focus on equal high and equal lows, and after I go through this, I'll be giving you guys a live chart example of all the different types of liquidity. So first of all, let me make sure that you guys understand what liquidity is. So all liquidity is money laying in the market. For example, if we look at these equal highs and equal lows, that where liquidity will be laying is right here. Now, why will liquidity be lying here? Liquidity will be here because people, retail traders, people that are not trading with smart money are all putting short positions here because it is a equal high and it is a resistance zone. So everyone has short positions like this. They have another short position like this every time this price taps at this resistance zone, and they have another short position like this. So every time this price action comes to this zone, retail traders and people that don't trade smart money are shorting this area. So what that means is everybody's stop loss, so everybody that is going short, everyone's stop loss lays just above these equal highs. So all here is liquidity from all these people shorting. So what will price most likely want to do? So price will want to come and take this liquidity, and the reason why this wants to happen is because big banks and big institutions, if they want to enter in a big move in a big order, they cannot just enter into a trade like us. They have to have millions of dollars laying somewhere. So right here is where millions of dollars are lying in the market. So this is what smart money will do, is they will come up into this zone, grabbing all this liquidity, then they will go back in the direction that they wanted to go in. So that is just a brief overview of what liquidity is. So it is just where money is laying, and it is where smart money and the big banks want to come up, grab all that money, and then move back in the direction that they wanted to grab. So if we look at these equal lows, all of the liquidity is laying below this point in this box here. All the liquidity is laying in this box right here, and if price action wants to carry on up, it doesn't have to be taken all the time, but it's very common that price action will go down, taking all this liquidity. Then all of these people who have just been stopped out longing this market will then enter into shorts, thinking that, oh, the price is going to carry on going down. But what actually happens is the price will then come back up, grabbing all this liquidity right here, grabbing all the liquidity of the people now open in short positions, and smart money would have just made a lot of money. So yeah. Equal highs and equals low is very common when grabbing liquidity. And then moving on to the next example, we have trend line liquidity. Now this could be any trend line. I will show you examples in the live market after this. So where will the liquidity lay on this? The liquidity will lie all under here. Sorry, that was a big box. The liquidity will lie all under here. So every time this price action here touches this trend line, what are people doing? What are retail traders doing? They're all opening their long positions like this, with their take profits up there. They're all opening long positions like that, take profits there, and etc, etc. So what smart money want to do? Smart money wants to grab this liquidity and grab all these stop losses. So what will smart money do? If price, let's say price wants to go up into this box up here, what smart money and the market makers are most likely going to do is come down, grab liquidity, so breaking this trend line, making people think, oh, the price is just going to carry on down. But what price is actually then going to do is come back up into where price originally wanted to go. So yeah, so it would have grabbed all the liquidity from the shorts, so they would have just grabbed millions of dollars right here. Then they would pump the price straight back up and they would have made a lot of money. Now if we move on to the third and final type of liquidity, this is buy and sell side liquidity. Now this is a bit more complicated, but it's nothing overcomplicated. So buying and sell side liquidity basically means the most recent swing high and most recent swing low. So as we can see here, we have a sell side liquidity. So market wants to go to the upside, but there is lots of liquidity laying right here that is left behind. So what prices most likely want to do is grab all of this liquidity left here before going back up. So as you guys should understand right here, and I will show in the live chart so it makes a bit more sense, there is lots and lots of liquidity lying right here from retail traders that are all opening long positions in this zone, and all their stop losses lay here. So when there are lots of stop losses in one specific point, what smart money wants to do is hit those stop losses. So all those people lose out on the money, they all get liquidated, then price action will pump back in the direction that they originally wanted to, or even price could fake pump that way and then carry on back down. You know, it doesn't necessarily always have to go back up after. It could do a little fake out like this, and then price action could carry on straight back down like that. So yeah, I hope that is quite simple. So all we are looking for is trend lines, equal highs or equal lows, or buy and sell side liquidity, but this liquidity is extremely important. So now let's go to a chart example, a live chart example, and I'll be looking at Ethereum, USDT. Now, I'm looking at crypto, but this strategy works for both Forex, indices, anything you want to trade. This works and is very important. So first of all, let's look and see if we can identify any trend lines where any liquidity will lay. So first of all, I'm actually going to go back to this point here because this is very interesting and this is a perfect example. So right here we have this trend line. We have lots of liquidity in this point. So what are retail traders doing? What are people that are not trading smart money doing? They are all opening long positions from this point. They are opening long positions because it is a nice resistant trend line. They are opening long positions here, opening long positions here, like that, aren't they? So what does smart money want to do? Smart money wants to pump the price below this point. Pump the price below this point so all of these stop losses get hit. So if we play out the chart, boom, price drops below this point very rapidly. Now when this happens, it normally does happen quite rapidly, so people don't have time to react. So the price pumps below this point very rapidly, and now what are people doing? All these stop losses have just been grabbed, so all these people have just lost a lot of money. So now people are saying, oh, price is going to carry on going down, let's open short positions. So now everyone's opening short positions, hoping price will carry on to the downside. So everyone's opening short positions, thinking, oh, the price is just going to tap off this trend line right here and carry on back down. Now, this is a chance price action could do this, but if smart money are involved, price action is most likely not going to do this. So what happens? We play the charts out, price starts to consolidate. It actually reacts off this point a bit, so people are all enter into their short positions right here. Everyone's thinking, oh yeah, price is going to carry on down. We've broke this strong resistance line. Lots of liquidity has been taken here. Now what is price going to do? Price going to pump up straight back in the opposite direction. Now everybody with these short positions here have all just been liquidated. They've all just lost a lot of money, and price action is now trading the opposite direction. Now that is what liquidity is. Liquidity is just where money lies, and when liquidity liquidity gets taken, smart money are involved in the market. Now let's take replay mode off and let's look at some live chart examples right now. So I'll leave that line on there for you so you guys can see what an example is of liquidity. So let me just mark that out for you. Now, if we go to the 1 hour chart, which we can identify some points of liquidity. And actually right now, price is breaking out of this liquidity. So if we mark this as liquidity, I'll just put dollar signs. You guys know that money lies here. So every time this price taps here, look, taps here, taps here, taps here, taps here, what are people expecting to do when this price hits this red line? People are expecting price to go down. So price taps here, it has now broke this liquidity line, this resistance line. So everybody that was in a short position here has just lost out on a lot of money. Now, price could easily carry on going up. People could all be entering into a long position right here because they think, oh, this trend line has just been broken, so now price is going to carry on to the upside. Now, this is a live chart, so I do not know what is going to happen exactly, but many things could happen from this point, because as you can see, all this liquidity right here has just been broken. Now everybody shorting from this position right here would have just lost a lot of money. So there's millions of dollars happening right now. So if smart money were to get involved into the market, they could easily carry on pumping the price up, meaning and breaking this buy side liquidity. Now I haven't showed a example of buy side liquidity yet, so this is buy side liquidity. As you can see, it is the most recent highest point on the market. So if people are opening trades for a longer time frame, where are those stop losses most likely to lie? Let's say people are opening short positions here. Let's say that, and their point where their stop losses are most likely to lie is at this point here, because it is the most recent highest point in the market. So let's say they have a trade that looks like this. All their stop losses are going to lay right here because it is buy side liquidity. So if you ever see a chart and it is marked BSL, that means buy side liquidity. Now, what will price want to do? Let's say price wants to come down into this box down here, which is a demand zone. Now, before this price can come, well, not necessarily it can, like what most likely happen before this price wants to come into this demand zone is price might want to grab all of this liquidity that is laying up here. So price could tap out of this liquidity. Now as you see, all these stop losses lay here. So what has just happened? Liquidity has just been grabbed. So all the liquidity that lies here has just been grabbed, and now all these people have just been stopped out in short positions. Now what also might happen is everybody that's in a long position right here, because of this resistance zone, price might want to come back and test this zone. So everybody, and what happens once this price tests this zone? Everybody's opening long positions because it is now our support trend line. Because as you can see, it was resistance, 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 and now it is acting as support as it has just been broken. So price might tap this zone, come back up, then a price might break this liquidity, and then price might carry on to the upside. Or the opposite could happen. Price could come up a bit, test this liquidity, break this liquidity completely, making everybody opening shorts, coming into this demand zone, then price might want to come carrying on up. So that is just two possibilities that could happen. And even with this red zone, price might want to break this buy side liquidity here, grabbing as much money as they want. But with day trading, it is not about predicting what is happening in the market. It's about reacting what happens in the market. So that doesn't necessarily mean anything. Now, also here we have this resistance zone. So what does this mean? We have this resistance zone. So because we have this strong trend line that is acting as resistance, that means that it's lots of liquidity there's millions of dollars laying underneath this red box right here. Now, liquidity is everywhere in the market. You guys must understand that. If we go to the 5-minute time frames, the 15-minute time frames, liquidity is literally everywhere, and liquidity gets taken. That's why people will lose out on money and people will gain money. Remember, day trading is a player versus player. If somebody makes money, then somebody has to lose money, and that is why liquidity has to exist. So as I was saying, all this is lots of liquidity laying right here. So what price might want to do is break this liquidity right here, then carry on up. You know, there's multiple things that could happen, and if you are trading supply and demand, identifying liquidity is extremely useful, because if you combine the liquidity with supply and demand, then you have a serious combination and you can make lots of money. Because if you want a valid demand zone, then there must be lots of liquidity laying. Now if I go to my Instagram, I'll show you guys an example of what I'm talking about. So here we go. I have this that I've posted on my Instagram. As you can see, let me just delete those comments. Delete. So as you can see, we have this demand zone right here, and we have this higher time frame structure. So price is very bullish, going to the upside. Now, what do we have here? We have liquidity laying here. So let me actually draw this out for you so you guys can understand how you can use liquidity when trading. So let's say we have this move to the upside. We have a higher high and price comes down, creating this liquidity right here. Price is creating this liquidity right here. Then price comes down, has a pullback into a demand zone, and then carries on right here. So if we look at this chart, let's draw our demand zone right here. Let me mark this out for you. Demand zone. So what do we have being created right here in this box right here? There is lots of liquidity. There is people that will have a position like this. People will be opening short positions here, all at this line. Every time this price hits this line, they'll open a short, and people doing the opposite here. Every time price comes to this line, they'll be opening longs. So it looks something like that. Now, what price will want to do is grab the liquidity. Oh, so as you can see, price will break that liquidity right here. So we have this trend line here. Price has broke that liquidity. Price will then come tap into this demand zone, because remember, everybody's opening shorts right here, thinking that the price is just going to carry on going down. So what does price do? Price comes into this demand zone, then comes shooting straight back up, grabbing all the liquidity that laid here. So that is basically liquidity. So it is just where money lays, and if you can learn liquidity perfectly, then you'll be able to add it to supply and demand, fair value gaps, imbalances, and you'll be able to create a trading strategy that works for you perfectly. So if this video did help out, make sure to like and subscribe, and thanks for watching.